Good Friday morning, Market Chameleons, and everyone who joined us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dmitry, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and good Friday morning, D.
Good morning, Will. How are you?
Good.
Good morning, everyone. I'm going to share my screen here, and I think today we will review a bullish strategy in NVIDIA, how to find a bullish call spread. So to do that, to go to the trade ideas, if you type in NVIDIA stock symbol up here in the search. Once you land on the summary page on the left-hand side under the options items, click on trade ideas and you will land on this page. And what this page does is use a scan with predefined conditions to look for trade ideas, different types of strategies that have a historical statistical edge. Okay, so that's what it's doing. It's looking for certain other conditions that are preset in our screeners, and these could be different types of strategies. If you click on this, you could look through the different types of strategies it's scanning for, and the default is it shows the top three by theoretical edge, but you could go in here and pick, if you want to just look at bull put spreads or credit iron condors. If it will scan it, and if it meets our conditions, it'll pop up in here. So looking at these, there's a long call over here, a bull call spread, and a bull put spread. Let's look at the bull call spread for now. And in this situation, this is what it found. There's a bull call spread. The strategy is in the January 10th expiration, as you can see here. It would be buying the 134 strike, selling the 139 strike. So bull call spread, it's in the same expiration, two different strikes. You're buying the lower strike, selling the higher strike. So this particular one is looking at the 134, 139 bullish call spread in the Jan 10 expiration. And it looks at the market price. So, spread, when we have a market, we have a bid and an offer in this spread. And since a bullish call spread is you're buying the low strike, selling the higher strike, it looks at the ask side of the spread and analyzes it. And of course, keep in mind, you're always trying to get a better execution between, if you have a bid and an offer and you could put in a limit order below it, in the midpoint, you're always trying to get a better execution. But the starting point here is just analyze it from the ask side, because that is the available price that you could get executed immediately. And that price is $2.70. Okay, so if and this is $5 call spread, right? 134, 139, $2.70 is the cost of it. And then let's start analyzing and looking at it from the perspective of valuation. And keep in mind, you'd have to have a bullish outlook on NVIDIA for this strategy. If you don't have a bullish outlook, then this wouldn't be the strategy to look at. And in particular, in this bullish call spread, you have an outlook that NVIDIA will be above 139 on January 10th expiration. Okay, so now that we see it, what do we think this strategy, given the amount of time left in trading, right, between now and January 10th, and the way the stock behaved historically, what do we think in theory this spread is worth, right? When we look at anytime you're dealing with financial assets or risk assets, you're running valuation models. Well, what do I think this is worth based on my assumptions, conditions, and models and methodology. So this is looking in particular how the stock historically behaved, and based on its behavior, what do we think the average value of this strategy is? And that's calculated for us $3.97. Okay, so it's looking in history, looking for similar situations. It'll look at it, if there was an earnings coming up, it'll include earnings. If there's no earnings, it'll take the data in history that didn't include earnings, it'll exclude it. Run those calculations and come up with this theoretical value. So that's a base model, right? Just to get a sense of where we think this could be worth around. That came up with $3.97. So looking at that, well, if history suggests it's average price is $3.97 at $2.77, it doesn't seem like a crazy price, based on that benchmark. Now, of course, maybe there's certain reasons we may believe this $2.70 is justified. We'll have to keep researching it. Maybe there's something else weighing on the market, or something's going on, or we're entering a particular period that it moves differently, maybe on the calendar year. But so far, that price looks reasonable from a historical perspective. And if we took the difference between the market price, right, and the theoretical price, well, that suggests a 47% edge. So that's a pretty big theoretical edge. All right, we don't know the outcome, right? We don't know what Nvidia will actually do, right? It could go up, it could go down. Nobody knows that for sure, because if we knew that for sure, this would be very easy. So that part we don't know, but in theory, there's this theoretical edge based on history. In addition, we could say, okay, we do have this average price of $3.97, but that average price could have gotten skewed higher for some reason. The averages may have skewed higher. So we could look at this $2.77 and ask ourselves, okay, given how the stock behaved historically, okay, I think this is looking at 4 years of data here. Given how the stock behaved historically, sometimes it went down, sometimes it stayed unchanged, sometimes it went up, sometimes it went up by a little bit. So looking at all those observations, if we looked at a similar spread, right, with this, we looked at the strikes, both of these strikes, with distance similar from the spot price, and we gave it this range, the days left between now and expiration, so it has some time still to trade. If we took that into consideration and said, okay, if assuming we use this price historically, how often did it result in a profit if we did the same spread, similar spread? any profit. It could be, you know, as long as it would have been at least by a penny or so. So from that, we get this historical win rate. So this saying that 78% of the time, NVIDIA's stock behavior, the way it moved, this spread would have resulted in a profit 78% of the time. Okay, so that's what this means. So now we have some stats here. You know, it may be interesting. We could go look at it further, but these are kind of just like baseline stats to help us out. You know, to see maybe we should look at it further. You know, or you could pass. Go to the options chain and set up your own strategy. But let's take a look at this from the options chain. So I'm going to come over here and you see like this little arrow options chain. If you click on it, it'll take us to the options chain. So I'm going to click on this and now it's going to open up a new window. Let me just close this menu to expand it. Now we have the options chain. It's the same expiration, January 10th. You see 19 trading days left, 29 calendar days left. And within this options chain, it already populated the 134 call for us. So you could see here, here's the 134 call. The ask price is 8.45. So over here, you could see the January 10th 134 call, $8.45. Then here's the 139 call. The bid is 575. So you can see here selling the Jan 10th 139 call, 575. So queued up this spread for us. If we run analysis, it'll complete the analysis for us. Before I run the analysis, let me just come up here and let's just get a sense of, you know, what is, historically what we're talking about, how the stock behaved. And we could look at it from a couple of perspectives. And here we have these historical stock patterns that analyze, you know, based on these, based on this expiration. It looks at 19 trading days. It looks at the calendar period, you know, starting from today's date to January 10th expiration. And it'll tell us how the stock behaves. So let's click on this. And here we have a 19-day stock outlook based on history. So you can see here, there's a seasonality and then a 19-day drift. So 19 days of stock trading, what does the stock tend to do? Or we could look at seasonality. Instead of 19 days, we just look from December 12th, because that's yesterday's close, to January 10th. Historically, you know, go back in history, the year before, the year before, the year before, and show me what the stock did. So the first one is, it's telling us the percentage of time the stock moved up in our observations. So seasonality, 58% of the time the stock moved higher. The drift, 65%. Okay, so we were looking at two different data sets, but both of them indicate that there's a historical positive drift. All right, so on the 19 days, over any 19-day period, it looks like 65% of the time the stock moved higher. A little bit less during this seasonal period, 58%. And this is the drift downward. What about the average return over those periods? So you can see here, on average, it was up 2.9%. This on average of 5.7%. So there's a positive drift, and you know, it looks like it has like pretty significant, you know, positive drift, almost 3% here, 5.7%. If we looked at the average move up versus average move down, you could see only the positive moves versus only the down moves, up 9.5%, 13.9, down 6.4, down 9.9. And this is to give us a sense of the range, you know, high, low. The best move up 18.8% seasonally, worst 9.3. The best move up 43%, worse 28%. So it's pretty volatile. But with the call spread, at least we are limiting our downside, right? So it's whatever you paid for that spread. So let's close this, and that just gives us a little bit more information that yes, Nvidia tended to have a positive drift historically. And let's run this analysis further. Let's go in there and just say run analysis. And once we do that, now we get more stats and historical data and charts to help us analyze this. So here, this is that historical stock return distribution where we're talking about the price is 270. And compared to how the stock moved historically, you could see this is the theoretical edge. There's another way we could analyze it. Instead of looking at the stock behavior, we could look at how were the options priced, similar options priced in the market under these similar circumstances, right? So if we had 19 days to go, we had strikes, that were a certain distance away from the spot price. If we went in history and just said, okay, there's implied volatilities, look at the implied volatilities, run it through the Black-Scholes model, and based on historical implied vols, how were these options priced and in history? So here it shows us a little bit different story. That would be $2.59, which if we use that average Theo, right? If we use that average Theo, that is below, we would be, if we're paying 270, that would be a little bit higher. So we'd have to still justify it. It doesn't mean it's necessarily a bad trade, but these are the benchmarks, and we'd have to sit there and kind of like justify, am I willing to do that? Which in this case would be 11 cents negative theoretical edge. We'd be paying 11 cents above. The median tells us, okay, if we looked at all our observations, right, using the historical implied volatilities, and we looked at all our observations and split them in half and said, find me the price where half of the observations were above, half were below. What would this value be? And that's $2.61. So that's very close to the average. So based on how options traders tended to price these options, using the historical implied volatilities, this would be around $2.60, right? And the range, right, because sometimes it's higher, sometimes it's lower, implied volatilities are moving around. So it's not always exactly the same. So what is the historical range? And using that, where would these, where would be the high and the low end of this spread? So that's $2.25 to $2.73. Okay. So now we have these that, like, really quickly, we could just, once we know what we're looking at, we could quickly just scan with our eyes and measure how the market is pricing relative to history now. Now, remember, I told you that this $2.70 is looking at that offer. So here's the current market. It's $2.50 bid, $2.70 ask. So you could see that the midpoint. So if we look at the midpoint, $2.60, well, that's if we look at the current market and we say, well, what do we think the fair value is, well, it's somewhere in between 250 and 270, because that's how the market's pricing. It could be 250, it could be 270 or something in between. So, the standard of saying the market's fair value is somewhere like right in between, which would be 260. So if 260 is the market's current fair value, you can see that falls right in line with the historical implied loss. So it's right there at 260. And keep in mind that you could put in a limit order, and it's possible that you could get executed at $2.60 or $2.65 or $2.55. You don't know until you put in the order what's on the other side. Somebody might be willing to step down, or there's a market maker that sees it and is willing to sell, or somebody else because it fits their portfolio. Then moving along, we could analyze this spread from its risk sensitivity. Because we're dealing with two different options, some of the risks are offsetting in this call spread, right? Because if you buy a call, well, it has positive delta, but you're selling a call that has negative delta. So some of it is offsetting. So what is our delta risk at this moment? Well, that's 12.6. Okay, that's what the delta is of this spread. Has a gamma very close to 0, negative 0.1. It has a vega less than 1, negative 0.4, theta 0.3, rho 1.1. And this is, I only put in one contract, so it's not a lot of risk in these. But these are giving us the risk sensitivities of this particular strategy if we convert it to our Greek risks. All right. Let's just move along here just so we could cover everything on this page. This is a price chart for today. And the price chart gives us an idea, well, how did this spread behave today? If we tracked it throughout the day. So this is looking at yesterday's date. Today we're not open yet, so this is a one-day chart for yesterday, and it has 3 lines. One is this dark yellow line, right? And that's tracking the midpoint of the spread. The reason it's tracking the midpoint is that option prices and option values are derivatives, and those values are changing as the stock is moving, and time decay and implied volatility. So those values are changing even though there may not be any trading in them. So a stock price, if we look at a stock price, for a stock price to move higher, it needs to have trades, right, that are at higher prices. And if it to move lower, it has to have trades at lower prices. That's how we track the value of this stock. But in option, it's a derivative. So its value, it's derived from where the stock price is. Even if it has 0 trades in an option, the value of that option is changing. It has a delta, has theta, implied volatility. So how do we know? How do we track it if there's no trades? Well, there are dealers and market makers that are continuously, on a continuous basis, producing prices that they're willing to buy and sell, bids and offers. So even without trading, if the stock is moving, there's cancel replaces and streaming quotes. So we could observe bids and offers. Okay. And those are firm. So because they're firm, you could trade on them. Those are real prices we could reference. Okay, those are how dealers and specialists, they're broadcasting where they're willing to buy and sell, and we could reference these prices. And because we can reference these prices, we could track the value of these options, how they're moving. So let's come up down here, and this is what the chart has shown us. One is it's looking at the midpoint, like we were talking about, of the spread. That's the yellow line. But the midpoint, it's good to track, but it doesn't tell us the full story, because if the bid and offer, the distance between the bid and offer is very wide, well, the midpoint's very suspect. It's suspicious, because when you're really wide, what is the real value of it? Because it could be anywhere closer to the bid, closer to the offer. You just have a wide market. Given that, we also track the bid, how the bid of the spread is moving, and the ask. So that's what these dotted lines are. This what color do you think this is? Well, burgundy or something?
Looks like burgundy.
Yeah.
We may be a little delayed. I don't exactly know at what point Rob is asking this. He's asking, I believe I recall Dmitry saying IV goes down if selling goes up. Is that correct, or am I hallucinating?
I said that today.
No, he says he recalls you saying it.
Okay, I don't remember in what context what I was referring to, but basically, when we talk about IV, implied volatilities, right? Well, implied volatilities are the relative premiums, relative values of an option, right? When implied volatility is moving up, the relative premium of that option is moving higher. If the implied volatility is moving low,
it's probably moving up because more buyers are entering the marketplace for those options, right?
There's a demand for it, right?
And the inverse, that when it's going down, there's more sellers coming in
demand to sell,
right?
Yeah. Exactly. That's where the pressure is, right? So for like anything, if you're moving things higher, there's a demand for it. Moving things lower, there's demand to sell. So really quickly, let's just cover this part. These three lines show us how the price of this spread moved, the midpoint, the bid and the offer, which allows us to see how wide the bid and the offer is around the midpoint. So if it's very close together, that means that the markets are very liquid and that the spread between the bid and offer are close. But we could see here changes. Sometimes it looks closer, like maybe over here, then it widens out. So the spread between the bid and offer could be wide. And down here, we actually measure that. We look at the midpoint price, the high, the mid. So this is the high, the low, the median, the average. And we could see that the start and finish. So this is where the midpoint is basically where it started on the day. Even though it moved around, the spreads started around 258 and ended around 260. What about the spread between the bid and offer? Well, the widest spread was 35 cents. The most narrow is 10 cents. The median is 20 cents and the average is 18 cents. So about 20 cents like over here. That's where we see where we on average saw at the median, but it got tighter, sometimes as tight as 10 cents. So this gives us a couple things here. We have a chart and a table to tell us, how the spread moved and the liquidity around it. How much how wide was it between the bid and the offer. And I'm going to finish here, but lastly, did this actual spread trade, this actual call spread, exactly like these two strikes and this expiration, did it actually trade? And we did witness at least one trade at 128.18. There's one trade here, not a lot, only a volume of two at a price of $2.70. Okay, with a reference price. So this lists the all trade summary for the day. Okay, we didn't get to it, but next time we'll look at the price chart to see the payoff. But I'm going to stop right there, Will.
All right, perfect, D. Great job as always. Everyone, thanks for joining the Chameleon community and watching this webinar. If you wouldn't mind, please click like. Any comments in the YouTube are always appreciated. And remember us to follow us on YouTube. All right, D, great job as always. Thanks everyone for joining. Have a great